Yes, guys. So, good afternoon to one and all. So, all those people who are listening to this lecture on today's date, I hope you people are looking at your last attempt of writing your IPCC Group 2 and you want to create and clear it so desperately because this is your last chance. I hope most of you who are listening to this might have already cleared your Group 1 because it's quite long time overdue. So, the concept is not to demotivate you, but to motivate you to write your last attempt being your best attempt. Now, we have this very regular saying that the first attempt being your best attempt. So let's try to prove that our last attempt will be our best attempt. So when we are looking at our standards in our group 2, which is the main scoring part, carries approximately 40 marks of weightage of your entire 100 marks of syllabus. Now, if I look at it on a very positive side, I think advanced accounting is one kind of subject which can pull you through your entire group 2 marks itself. Let's take my case. I was a 70 plus in accounting and 40 and 40 in our ITSM and auditing. So that is how we clear it. Everyone is of different nature, but most of majority of the students are of such sort who believe that advanced accounting is a place where you can genuinely score higher marks than you can generally score marks in your auditing or your information technology and strategic management. So that is the reason why I think a higher amount of emphasis should be laid on this topic of advanced accounting, and more importantly towards the accounting standards, because it is very easy to answer a standard if you know what is being asked out. So be very specific to what is being asked about. That is all that I can say. Now, I don't want to extend too much into explaining you about the logics behind answering the standard, because I'll be concentrating on covering majority of the standards available. So what are the standards that we have? The standards that we have are AS4, AS5. AS4 is contingencies and events occurring after balance sheet date. 5 is net profit and loss and change in accounting policies. These two are fairly a simple standard. But whenever you're dealing with 4, remember always to make sure that you also read your auditing standard on subsequent events. Also read your auditing standard on subsequent events, which will help you understand this part much better. Along with that, we have the most important standards coming up, which will be 11, foreign exchange, 16, borrowing cost, 19, that is leases, 20, EPS, and 26, which is your intangible assets. Obviously, 29, which is actually in line with AS4 because it also deals with contingencies. Apart from contingencies, also deals with something called as provisions. Now, these are particularly the 7 standards that we have as far as our advanced accounting is concerned, but the standards are not as advanced as we think. The crux of the entire standards deal with are here. These 5 standards which I blocked out will stand out because they are most important standards of all, and make sure that you people do not miss out or do not make a choice out of these 5 standards that we're going to deal with. At stretch, we'll be dealing with these 5 standards. If time permits, I will take up AS4, 29, and 5. Clear? So let's begin with our AS11. One of the genuinely important standard, guys. Deals with effect of change or changes in foreign exchange rates. It deals with effect for changes in foreign exchange rates and what is the accounting impact that you have to give. That is the crux of this particular standard. This standard, broadly, I can break it down into 3 parts. The 3 parts into which I'll break it down is the first one, which deals with a foreign currency transaction. The second part of the standard will deal with foreign operations. While the third part of the standard would deal with forward exchange contracts. I will not go too much into the depth of foreign exchange contracts because this involves a lot of your financial management. So I will not be dealing with it in depth. And at the same time, it is not as important as we think for the level at which you are attempting the exam. So let's break this down into three parts and let's start one by one about what does each one deal with. What do we deal under foreign currency transactions and what do we deal under foreign operations? Before I get into the ambit of each one of them and start discussing them in detail, I'll have to understand few terms which are specific to the standards or even more specific to AS11 as such. One such terminology which is specific called as what is a foreign currency. In comparison with what do you mean by home currency? I'm basically talking about two currencies out here. One basically dealing with foreign currency, other one dealing with what is a home currency. What is a foreign currency? First of all, a foreign currency is anything other than home currency. Now, you cannot define home currency as other than foreign currency now, because foreign currency itself was defined as other than home currency. So I need to establish a definition for home currency as per the standard. According to the standard, home currency is the currency in which an enterprise presents its financial statements. An enterprise presents its financial statements. If there is an enterprise which is having a permanent establishment in India or an enterprise which is registered in India, has to particularly present its financial statements in rupee terms. So rupee becomes my home currency and any other currency in which I do a transaction will be called as a foreign currency. So keeping these two aside, let's start looking at what else do we know about it. What are the different terms within the standard apart from this home currency and foreign currency? The very important terms are, if you remember, the type of accounts. If you remember your type of accounts, we used to have our type of accounts defined like this. We generally have real accounts. We have personal accounts. And we also have our nominal accounts. I will change the names not just for this standard, but generally also standards do not name real accounts, personal accounts, or nominal accounts, but it gives a different terminology altogether. What is the terminology used in the standard? Real accounts are basically called as non-monetary items. They're called as non-monetary items. Same way, your personal accounts are called as monetary items. While there is no change for nominal, it will still be called as nominal items. It will be continued to be called as nominal items. So real, personal, and nominal are the three types of accounts that we generally deal with, which as per the standard, that is AS11 or any other standard, we use generally the terms of non-monetary items, monetary items, and nominal items. Now, if you want to particularly define what is a monetary item, A monetary item is an amount which is receivable or payable in fixed sum of money. Let me just say, monetary items are items which are receivable or they could be payable in fixed sum of money. Now, questions might come up. What is this fixed sum of money? And can you name a few examples for that? Fixed sum of money means if I have to give certain examples for this, I can give the examples of debtors and creditors. Amount receivable or payable in fixed sum of money. Bills receivable and bills payable. Advances and loans. Cash and bank balances or bank OD. All these can be called as monetary items. I'm leaving it as etc. because there could be plenty more. So I'm calling these items as monetary items which are receivable in fixed sum of money. Guys, in general terms, if I look at what is coming up later on, in today's language, these monetary items are also called as financial items, or they can be called as financial assets and financial liabilities as a part of financial instruments. Okay, so a different terminology is being used as time passes by. So as for AS11, I'll still stick to the word called as monetary items which are receivable or payable in a fixed sum of money. Like I've given you examples, these are monetary. Then what is my non-monetary item? Non-monetary item is simply other than a monetary item. That's it. What are nominal items? Expenses, losses, incomes, gains, they come under nominal items. Now that we have understood what is a home currency, what is a foreign currency, what are monetary items, what are non-monetary items, so let's start getting into the ambit of the standard, which first deals with a foreign currency transaction. Start with that heading. Foreign currency transaction. Could be transactions of any nature, guys. Could be a purchase of material, could be a sale of good, could be a loan taken, could be a loan given, could be a loan repaid in foreign currency. Any transaction which is denominated other than in home currency. Any transaction which is denominated in foreign currency can be called as a foreign currency transaction. Purchase of a machinery from Japan in their own currency. So, or purchase of a machinery from Germany in euros, foreign currency transaction. Sale to a customer in United States in dollars, foreign currency transaction. Borrowing of a loan in dollars from US. So that is also a foreign currency transaction. So all these transactions which are denominated other than in your home currency shall be continue to be called as a foreign currency transaction. The question comes up, all my books of accounts are in home currency, Indian enterprise, all transactions are recorded in rupee terms. So you kept on writing your journal entries in rupee terms. Suddenly foreign currency transaction came up, which involved a sale of a particular good to a customer in United States for dollars. How will you write customer account debit to sales? And let's say the value is $5,000. How will you write the transaction? That means you cannot write the amount unless and until that foreign currency is converted into my home currency. So therefore, the dollar has to be converted into a rupee terms. for me to pass a journal entry or for me to start recognizing that particular transaction. Therefore, such foreign currency transaction should be multiplied by a particular exchange rate. What is that particular exchange rate which I have to multiply it with so that I can start recording the transaction in rupee is basically what we are looking at under foreign currency transactions. So I'll break this down into two parts. First part which deals with recognition. And second part which deals with measurement. Recognition and measurement are two very, very important aspects as far as the standard is concerned. Yes, guys. So recognition and measurement of these foreign currency transactions should first start with part A, which deals with initial recognition. What do you deal under initial recognition? Under initial recognition, what is the first time that I recognize the transaction? When is that? On the date of transaction. I have to recognize the transaction on the first date. On the date of transaction. Initial recognition on the date of transaction should always be at measurement exchange rate on date of transaction. It should be measured at exchange rate on date of transaction. So let's say the transaction has occurred on 7th of November 2020. It was sale of a good to a customer. Sorry, 9th of November 2020. Sale of a particular good to the customer in United States at $5,000. I'll record the entry customer account debit to sales, but I cannot write $9,000. So $9,000 multiplied by today's exchange rate 73, 74, 75, whatever is the exchange. That is my initial recognition on the date of transaction. But similarly, I'll also have to do subsequent recognition. My subsequent recognition should only be for monetary items. Your non-monetary items or your nominal items need not be recognized subsequently. My subsequent recognition also happens or occurs twice. First time on balance sheet date. Second time on settlement date. There is a balance sheet date which falls in between. Then on that date, I will subsequently recognize. And apart from that, I'll also subsequently recognize the transaction on settlement date. On balance sheet date, I'll have to recognize the transaction. Here on the date of transaction, I've used exchange rate on date of transaction. But on balance sheet date, I will start using something called as a closing rate. Then question comes up, what do you mean by a closing rate? According to me, a closing rate is nothing but exchange rate on balance sheet date. On the date of balance sheet, whatever is the exchange rate of that particular foreign currency, that should be considered as a closing rate. On settlement date, I will measure it or I'll recognize it at exchange rate on date of settlement. Remember, guys, this subsequent recognition either on the balance sheet date or on settlement date occurs only for monetary items. It will occur only for monetary items. Now, initially, you recognize the transaction at 73 rupees. On balance sheet date, the dollar value has come down to 71. Let's think positively from India's side. Let's say the rupee has appreciated or the dollar has depreciated and it has become 71. Therefore, the monetary items should be only recognized at a closing rate, that is exchange rate on balance sheet date. Initially recognized at 73, now recognized at 71, 2 rupees of difference does emerge. This 2 rupees of difference is basically called as exchange gain or loss. Difference on subsequent measurement should be considered as exchange gain or loss. This exchange gain or exchange loss should be recognized in P&L. So they are considered as gain or loss in your P&L. If it is a loss, debit it to the P&L. If it is a gain, then credit it to the P&L. So this is the treatment of any difference emerging on subsequent measurement of monetary items, either on the balance sheet date or on settlement date. So it emerges only on monetary items. Non-monetary items or nominal items will not have any such impact at all. Clear? So this is the aspect regarding my this is my aspect regarding my foreign currency transactions. Now, let's get into the second aspect of the standard. Look at it. The first aspect of the standard was foreign currency transaction, which we have dealt with. Second aspect of the standard deals with foreign operations. Let us deal with foreign operations. When I deal with foreign operations, guys, understandably, foreign operations can be divided into two types. One is called as integral foreign operation. Other one is called as non-integral foreign operation. A question comes up. First of all, what is a foreign operation? Foreign operation is, let's say the enterprise is an Indian enterprise conducting its operations in India, but has a branch or a subsidiary which is operating from United States of America or is operating from the UK branch in London. So what is happening here? There's a foreign branch which is coming up, or a foreign subsidiary which is coming up, or a foreign associate which is coming up. Those are called as foreign operations. It's a branch or a subsidiary or an associate or a joint venture. Whenever I'm looking at these kind of foreign operations, which is a branch or a subsidiary or an associate or a joint venture, whatever it could be whatever I'm saying. Now I'm trying to classify it into two types. Question comes up, first of all, should AS11 deal with this? I'll answer the question very fair and straight. Remember, if it is a branch, when I prepare the financial statements of my enterprise, then I will have to incorporate even the branch trial balance with my operations to draft one single financial statement. Be it subsidiary, associate, or a joint venture which is established outside the home enterprise or outside the home country in which the main holding company is standing. In such cases, also for the purpose of consolidation, I'll have to borrow the financial statements of subsidiary, associate, and joint venture and have to combine the financial statements. So, for me to combine the financial statements, I have a particular problem. What problem? Here, the head office or the holding company is drafting its financial statements in India in rupee terms, while the foreign branch, which is in US or in UK or in Australia or in Canada or in Singapore, is drafting its financial statements in other than rupee terms. So their trial balance is of different currency, your trial balance is of a different currency. But for the purpose of drafting the financial statements of the enterprise, I need to combine both of them. How do I combine? What is 1 rupee per plus $1? And I don't know, 1 rupee dollar, nothing like that. So you cannot add both of them because there is no common unit of measurement. So what should I do? I'll have to bring down the common unit of measurement in such a way that these foreign operations which are having a trial balance in foreign currency will translate themselves into the trial balance into home currency. Clear? That is an aspect or a concept of why foreign operations is dealt under AS 11. First of all, what are integral foreign operation? Integral foreign operation in simple sense are dependent branches. Non-integral obviously are independent branches. Dependent or independent is assessed with the aspect of how is the foreign operation actually conducting its operation. Let's say the foreign operations is only an offshore unit which markets and sells the products which are manufactured by the Indian enterprise, then the foreign operation is directly dependent on the home operations or the head office for the purpose of procurement of material. In such cases, we call it as a dependent foreign operation. Its dependence could be for the raw material, it could depend for the sales, it could depend for cash, it could depend for any other particular reason. Such kind of dependencies indicate an integral foreign operation, while if there is no such dependency, it should be dealt as non-integral foreign operation. Whenever I deal with these two, I said the aspect regarding the standard is that my foreign operation trial balance this which is in foreign currency has to be translated. I'll have to translate. What will you translate this into? Translate it into home currency. Why do you have to translate the foreign currency trial balance into home currency? I need to do that facilitate preparation of financial statements. Underlying objective is that to prepare the financial statements. To prepare financial statements, your foreign operation, which is in foreign currency, having a trial balance in foreign currency, have to be translated into a trial balance of currency. Again, I'm looking at translation. So when I translate a foreign currency into a home currency, I'll have to apply appropriate exchange rates. What are your appropriate exchange rates out here? My appropriate exchange rates go like this. I'll put a heading. Translation procedures. When I'm looking at translation procedures, what do I translate? A foreign currency trial balance have to be translated into home currency. Fine, very good. A foreign operation trial balance which includes items have to be translated using any particular exchange rate. Exchange rate applicable for translation. Let's see what are they. Like we always know, guys, there are two types of operation, integral and non-integral. Let's identify them separately. Integral, what is the exchange rate? Non-integral, then what is the exchange? Your trial balance has real accounts, personal account, nominal accounts. These real, nominal, and personal, I have changed the names already. I have told you what they will be called from here on. I told you that they will start be knowing as non-monetary items, monetary items, and nominal items. Same classification I'll bring down into my foreign operation trial balance. First item is non-monetary items. Under this aspect of non-monetary items, I'll have again two classifications. One classification which deals with those kind of non-monetary items which are carried at historic cost. What are the non-monetary items which are carried at historic cost? Long-term investments, fixed assets, intangible assets, they are carried at historic cost. Such kind of non-monetary items which are carried at historic cost, what is the exchange rate applicable? The exchange rate applicable is for integral operation, exchange rate on date of acquisition. The date when you acquired, the date when you have acquired those foreign, those non-monetary items should be the exchange rate applicable on the date of acquisition for translating a non-monetary item which is carried at historic cost. But non-integral foreign operation, to translate a non-monetary item carried at historic cost, will use closing rate. Here. So I'm saying a foreign operation which has a trial balance in foreign currency should be translated into home currency. For this purpose, I will have to create translation procedure. For the procedures, the first item in the trial balance which I've identified as non-monetary items, which are classified as carried at historic cost, they will be translated using exchange rate on date of acquisition for integral operation and closing rate for non-integral operation. Second classification under non-monetary items is those items which are carried at fair value. Items carried at fair value are inventory and current investments. Inventories and current investments are items which are non-monetary in nature, but they're not carried at historic cost. Instead, they are carried on at fair value. Under integral foreign operations, I will apply exchange rate on date of determining fair value for non-monetary items carried at historic cost. We have seen different exchange rate. But for non-monetary items carried at fair value, exchange rate on determining fair value, on the date of determining fair value, and it will be the same even for non-integral foreign operation as well. Let's get into the next one now. Part A, monetary items you have seen. So let's come to part B. Let's see monetary items. Monetary items should always be translated using closing rate. What was closing rate? We have already seen exchange rate on balance sheet date. It would be the same either in the case of monetary items or in the case of non-monetary, either in the case of integral operation or in the case of non-integral operation. Let's see nominal items, which are nothing but your incomes, gains, losses, expenses. What is the exchange rate applicable? Exchange rate on date of transaction. But understand, guys, this becomes very difficult. Why is it so? Because they're nominal items, and every day, let's say I have 5 nominal items. So let's say 360 days, 360 into 5, 1800 nominal transactions have occurred. 1800 nominal transaction using 300 different exchange rate if I have to apply becomes practically impossible. Since it becomes practically impossible, he'll add a statement saying that if impractical, apply average rate. Average rate is nothing but opening rate plus closing rate divided by 2. I'm saying nominal items in the trial balance of a foreign operation should be translated using exchange rate on date of transaction. But I'm saying it becomes impossible or impractical if those foreign operations are, or if those nominal items are quite a few number. In such cases, apply average rate. It will be the same even for integral as well as non-integral foreign operation. So if you observe in all the translation procedure, only one thing stands out. What is that stood out? Non-monetary items which are carried at historic cost, because only in this case there's a different exchange rates being applied for both integral as well as non-integral foreign operation. Apart from this, in all other items of trial balance, I'm applying the same exchange rate to translate an integral or a non-integral financial statements of a foreign operation. There, but there will be one more difference which will emerge. If you keep multiplying with all these different exchange rates, your trial balance which tallied in foreign currency will not tally after translation into home currency. Therefore, there will be a difference which will emerge. Such amount of difference after translation into home currency can be called as exchange gain or loss. There will be a difference which will emerge when I apply different exchange rates for each item in the trial balance. Therefore, such differences will be considered as my exchange gain or loss. For the case of integral foreign operation, I will straightforward transfer this amount to P&L. But for non-integral operations, I will transfer it to a reserve called as CTR or FCTA. What is this FCTR or FCTA? is called as foreign currency translation reserve or translation adjustment. Translation reserve or translation adjustment. Difference after the after translation. Action, guys. Translation. Will be transferred to P&L in the case of integral operations, and in the case of non-integral operation, I'll either transfer it to FCTR or FCTA, that is foreign currency translation adjustment and foreign currency translation reserve. Clear? Now, I will end the standard discussion here, but towards the end, I'll deal with something called as translation procedure. What do you mean by this translation? Sorry, transition procedure, not translation. Transition procedures or transition provisions. Guys, these transition provisions are the most trickiest part. These are para 46A of AS11. The last paragraph. Transition means what? Temporary. So temporarily, these provisions were applicable beginning from 7th December 2006 to 31st March 2009. What are these transition procedures talking about? He says, if I have a long-term foreign currency borrowing, the enterprise has taken a long-term foreign currency borrowing. With this long-term foreign currency borrowing, they have acquired a depreciable asset. Depreciable non-monetary asset. Guys, remember, your long-term foreign currency borrowing is particularly a monetary item because it is payable in a fixed sum of money. It is definitely a monetary item. Whenever I say monetary item, they should be recognized subsequently or they should be measured subsequently. Subsequent measurement. Subsequent measurement here happens on balance sheet date using a closing rate. When I have done subsequent measurement on balance sheet date using a closing rate for the monetary item, this will definitely result in exchange gain or loss. Correct? We have seen that under foreign currency transactions, that any monetary item when subsequently measured on balance sheet date using closing rate, it results in exchange gain or loss, and such exchange gains or loss should be transferred to P&L. transferred to P&L. This is what we have learned. Then why transition provision separately? Here is the adjustment. He says this transfer to P&L is my option number 1. Either you can transfer this exchange gain or loss to P&L, or this resultant exchange gain or loss can be adjusted to the value of can be adjusted to the cost of asset. Instead of transferring it to your P&L, I can apply an option number 2. What is your option number 2? Option number 1, either you take it to P&L, or option number 2, you adjust it to the cost of the asset. What is the impact? If I would have taken it to P&L, then it would have clearly shown on the debit or credit of the P&L immediately. But if I adjust it to the cost of the asset, then what will happen? If it was a foreign exchange loss, I would have debited it to P&L, or I can add it to the cost of the asset. If I add it to the cost of the asset, then the cost of the asset increases. Since it is anyways depreciable in nature, then higher amount of depreciation will come into the P&L. But what will happen? The depreciation will be spread over the useful life of the asset. Therefore, such amount of exchange gain or loss, instead of being charged to P&L in the same year, it will be spread over the useful life of the asset. So a little bit of relief was given. There's a background of why this has come in also, guys. But remember, these options, option number 1 or 2, options selected are irrevocable. What do you mean by irrevocable? You cannot swap between option 1 and 2 at a later point of time. If you would have taken the option of transferring it to P&L initially, you can never go back to transferring the exchange gain or loss to the cost of the asset by option number 2. If I have previous year, I have already applied adjusting it to the cost of the asset, next year I cannot transfer it to P&L. This is an irrevocable option given under transition procedures. A question will be asked, sir, 2020 COVID time we are discussing this topic, where you are talking about this transition provisions are only available up to 31st March 2009. How is it relevant on today's date? 2009 got extended to 2010. 2010 again got extended to 2011. 11 got extended to 2012. 4 times amended section, guys. What do you expect from this? Got amended once again, now applicable up to 31st of March 2020. So until the end of the current financial year that we have just passed by, these transition provisions are very much applicable to the companies who have taken a long-term foreign currency borrowing to acquire a depreciable non-monetary asset. Non-monetary asset, no subsequent measurement, but monetary item, that is a borrowing, there is a subsequent measurement on balance sheet date applying a closing rate. For subsequent measurement, if there is a resulting exchange gain or loss, either I can transfer it to P&L or I can adjust it to the cost of the depreciable asset. Either of these options, once exercised, are irrevocable. You cannot change the selection once again. These provisions are applicable up to 2020. This is appearing as per para 46A of AS11. That will bring us to the end of discussion regarding Accounting Standard 11, effect of changes in foreign exchange rates. Guys, we'll take a 2 minutes breather, guys. Fast breather. make sure that you're back. We will deal with your AS16 from now on, that is borrowing cost. Yes, guys. Yes, guys. So now that we are done with AS11, let's get into the concept of AS16 borrowing cost now. Deals with borrowing cost. First, we will start discussing about what is the definition of borrowing cost. The definition of borrowing cost is dealt under para 4 of the standard. Definition para 4. While your para 4A deals with, I'm defining borrowing cost. Borrowing cost includes first part. Includes interest and other commitment charges. What are commitment charges? The amount which I have committed to pay on a periodic basis. Other commitment charges. Part B, interest and other commitment charges. Part B will deal with amortization of expenses incidental to borrowing. Amortization of expenses incidental to borrowings. If someone wants to write an example, bank charges something called as processing charges. Bank processing charges of a loan is generally ranging between 1.5 to 2.5%. So this 1.5 2.5% are expenses incidental to arrangement of a borrowing. Such expenses are amortized over the period of borrowing. Let's say the borrowing is for 5 years, then I'll amortize it over the period of the entire 5 years. So that is called as amortization of expenses incidental to the arrangement of a borrowing, which is para 4b of borrowing cost. Then comes para 4c. Para 4c deals with amortization of discount on issue or premium on redemption of borrowing or a debt instrument, guys. Discount on issue. Let's say debentures. Debenture is also a borrowing. A debenture or a bond has been issued at a discount or is supposed to be redeemed at a premium. It is considered as loss to the company. Such loss to the company is amortized or up to the date of the redemption. Let's say the debentures are issued for 10 years, then the discount on issue or premium on redemption considered as loss to the company will be amortized over the entire 10-year period, which will also be included as a part of your borrowing cost. Para 4D deals with finance charges under finance lease. Guys, what is this finance charges under finance lease? We will deal with under leases under AS 19 specifically. You can let it go as of now. We'll further deal with it under AS 19. Para 4E becomes the most important concept because it deals with exchange difference. To an extent, they can be regarded as borrowing cost. Exchange differences, to an extent, they can be regarded as borrowing cost. Now, this is the most important aspect of the definition, where we'll have to understand this with the help of Accounting Standard Interpretation 10. ASI 10 will be brought out to identify and understand what is this exchange differences to the extent they can be regarded as borrowing cost. I started your borrowing cost with the definition, and I said a definition of a borrowing cost is given under para 4. Para 4 includes interest and other commitment charges, amortization of expenses incidental to borrowing, amortization of discounts on issue or premium on redemption of borrowing, finance charges under finance lease, and exchange differences, they can be regarded as borrowing cost. What is this Accounting Standard Interpretation 10? Accounting Standard Interpretation 10 for para 4E of borrowing cost. AS 16. My ASI 10 dealing with this exchange differences, to an extent they can be regarded as borrowing cost. To understand this paragraph, ASI 10 talks about a particular example. I change the numbers, but I'll give you the similar example. Let's say an enterprise has an option to borrow funds. Your borrowings can either be in rupee terms, or you can borrow in dollars. In rupees, I should have borrowed, or I would have borrowed, my requirement of a borrowing is, let's say, a lakh, 1 lakh. Such borrowing in rupee at 1 lakh carries a rate of interest at, let's say, 10%. Okay. That means my interest payable per annum would come down to about 10,000. Similarly, the enterprise has an option to borrow in dollars. How many dollars? Let's say the exchange rate on date of borrowing, for the ease of calculations I'm putting it, don't take otherwise, is rupee 50 per dollar. If it is 50 rupees per dollar, then I would have borrowed $2,000. And question comes up, why should you borrow in dollars? Because the dollar borrowing rate was only 5%. Therefore, I would have paid at the end of the year only 100. I would have paid only $100. Either paying 10,000 rupees or $100, I wanted to compare. Towards the end of the year, the exchange rate has today become 54 rupees per dollar. It has become 54 rupees per dollar. Therefore, if I have to pay $100 at 54 rupees per dollar, that means I will end up paying how much? I'll end up paying 5,400. I'm still happy about borrowing in dollars, because had I borrowed in INR or rupee terms, I would have landed up paying an interest of 10,000. Since I borrowed in dollars, I'm paying only an interest of 5,400. Comparing these two amounts, I can say that I have a savings in interest cost. How much savings do you have in interest? My interest cost saving can be considered as 4,600, which is nothing but 10,000 minus 5,400, which is 4,600, being considered as my savings in interest cost. Clear? Now, by the time the enterprise feels happy that their borrowing in dollar created an interest saving of 4,600, then the question comes up, there is an exchange loss on the borrowing. What is the exchange loss on borrowing? Remember, your borrowing was $2,000. That means you'll have to pay $2,000 to repay the loan. When you took the money, you got only 1 lakh rupee from that $2,000 of borrowing. But now, in this current situation, the change is completely different. Because now you get a logic that that $2,000 will now be repaid at 54 rupees per dollar. Therefore, I will get a loss of 4 rupees per dollar. $1,000 into loss of 4 rupees per dollar will give me an exchange loss of 1,000. Now you tell me what happened. To save an interest of 4,600, this fellow in turn got an exchange loss on the foreign currency borrowing for $8,000. Yeah. In these kind of scenarios, he'll say, exchange loss regarded as borrowing cost. will be considered as lower of above. That is 4,600 rupees, which should be considered as my exchange loss to be considered as a borrowing cost. So I'll put it like this. According to para 4E, borrowing cost is equal to lower of part A, savings in interest cost, part B, exchange loss on foreign currency borrowing. Lower of these two should be considered as my borrowing cost as per para 4E. So if you remember, you actually got an exchange loss of how much? My exchange loss, according to the question, was about 8,000 rupees. 4 rupees per dollar on $2,000. It was resulting in an exchange loss of 8,000. Here he'll say this 8,000 rupees, of which I've considered 4,600, which is the savings and interest cost being the lower of exchange loss, or the savings and interest cost should be considered as borrowing cost as per AS 16. There is still some balance left out. What is the balancing figure that I should get here? The balancing figure is 3,400. This 3,400 rupees of a balance, other than that 4,600, which is considered as borrowing cost, treated as per AS 11. This is a very, very important paragraph of AS 16, which is read along with the concept of ASI 10, which is explaining you what are you supposed to do and how much of exchange loss should be considered as foreign currency borrowing. So how much of exchange loss should be considered as borrowing cost? Lower of the savings in interest cost or the exchange loss arising on foreign currency borrowing. So where the exchange loss was 8,000, I considered 4,600 as borrowing cost. The balance 3,400 I will treat it as per AS 11, where I would have charged it to PL. Now someone will ask me a beautiful question. The exchange loss also transferred to P&L as per AS 11. Borrowing cost, interest, anything anyways going into your P&L. How does it make a difference of bifurcating the amounts? That is where the treatment of borrowing cost becomes very important. Treatment of borrowing cost. What is so peculiar about your AS 16? He will say that these borrowing costs on a qualifying asset on a qualifying asset is eligible to be capitalized. eligible to be capitalized. What do you mean by capitalized? That means you can add it to the cost of the asset. While any other borrowing cost, I'll simply charge it off to P&L. Treatment of borrowing cost on a qualifying asset, it is eligible to be capitalized. On any other borrowing cost, I'll straightforward charge it off to P&L. Now, the question comes up, first of all, what is this qualifying asset? What do you mean by a qualifying asset? And what is the amount which is eligible to be capitalized to that asset as borrowing cost? What is a qualifying asset? Let's see. A qualifying asset is an asset which necessarily takes a substantial period of time. Substantial period of time to get ready for its intended use or sale. Get ready for its intended use or sale. I hope everyone knows that an asset held for use is nothing but my fixed assets. But my assets held for sale are nothing but my inventory. Therefore, it means to say borrowing cost is eligible to be capitalized on a qualifying asset, where such qualifying asset can either be fixed asset, which is held for use, or it could also be an inventory which is held for sale. My question would be, what do you mean by substantial period of time? This is explained with the help of, a substantial period of time is explained with the help of ASI 1, Accounting Standard Interpretation 1, where he says such substantial period is rebuttably assumed. Words very simple, guys. Rebuttably assumed. They are rebuttably assumed as not shorter than 12 months. Question comes up. I know assumption, but what do you mean by rebuttable assumption? Assume, I know. What is rebuttably assumed? Rebuttably assumed means it can be contradicted. I can contradict the assumption. It can be contradicted if sufficient facts are provided. What are you saying? A qualifying asset is an asset which necessarily takes a substantial period. Substantial means more than normal period to get ready for its intended use or sale. What do you mean by substantial period? Substantial means I am assuming that the period is always less than or is always more than 12 months. A period shorter than 12 months cannot be considered a substantial period. However, since it is a rebuttable assumption, it can be contradicted. That means you can consider that a substantial period is less than 12 months if sufficient facts of the case are provided for. If you have sufficient facts of the case, then the substantial period of time can be considered as even less than 12 months. Here. Now, once we have understood this concept of why are we dealing with Ind AS your AS16, because you are saying borrowing cost is eligible to be capitalized on a qualifying asset. What is a qualifying asset? An asset which necessarily takes a substantial period of time to get ready for its use or sale. Therefore, an inventory or an fixed asset can be considered as qualifying asset on which the borrowing cost can be capitalized. When do you call it a substantial period? Any period which is not less than 12 months can be considered a substantial period. However, it is a rebuttable assumption. Therefore, if there are sufficient facts of the case, a period shorter than 12 months can also be considered as substantial period of time. Here. Now that will bring us to the end of discussion on what is a qualifying asset. On the qualifying asset, what did we say? Borrowing cost is eligible to be capitalized. Let's see. Borrowing cost eligible to be capitalized. What is the borrowing cost eligible to be capitalized? To explain this concept, I will differentiate the borrowings into two types, or I'll classify the borrowing into two types. First type of borrowings are called as specific borrowings. Second type of borrowing is called as non-specific or general borrowings. Or general borrowings. So guys, what is a specific borrowing and what is a non-specific or a general borrowing? When I deal with specific borrowings, I'm saying a borrowing which is particularly taken for the purpose of the construction of qualifying asset. If I'm taking a particular borrowing, particularly for the construction of qualifying asset, then it is considered as specific borrowings. Which is specifically taken for construction of qualifying asset. Such is called as specific borrowing. Borrowing specifically taken for the construction of a qualifying asset. Now, non-specific borrowing, I don't want to discuss any further because I'll simply say it is other than specific. I'll tell you what exactly the standard reads, guys. Standard reads specific borrowings like this. It says a borrowing which would have been avoided, had the construction of qualifying asset not been taken up. If I wouldn't have taken up the construction of qualifying asset, then I don't need this borrowing. I wouldn't have taken this borrowing if I wouldn't have had this qualifying asset. Or in other sense, I've taken this borrowing specifically for the purpose of this qualifying asset. That's why the wordings of the standards are very tricky, but they'll mean something very simple. Okay. So whenever I'm talking about specific borrowing, what is the borrowing cost eligible to be capitalized? Borrowing cost eligible to be capitalized is equal to borrowing cost eligible to be capitalized is equal to actual borrowing cost reduced by minus return on idle funds. Whatever actual borrowing cost which I incurred on the specific borrowing reduced by the return on idle funds is the borrowing cost eligible to be capitalized for a specific borrowing. When I talk about a non-specific borrowing, it is not specific. Let's see. Can I take the same thing? Actual borrowing cost. The entire borrowing has not been used on the qualifying asset. How can you take the entire borrowing cost as capitalization cost? Therefore, I'll put it like this. Borrowing cost eligible to be capitalized is equal to borrowing cost eligible to be capitalized equal to my borrowing cost eligible to be capitalized is equal to the borrowing utilized on qualifying asset. How much borrowing did I utilize for the construction of qualifying asset? Multiplied by a capitalization rate. Borrowing utilized on qualifying asset multiplied by capitalization rate. What is a capitalization rate then? I'm saying a general borrowing or a non-specific borrowing completely hasn't been utilized only for qualifying asset. Therefore, entire borrowing cost cannot be capitalized. So to identify the borrowing cost eligible to be capitalized on a general borrowing or a non-specific borrowing, I'm trying to identify how much of borrowing is utilized on the qualifying asset, and I'm multiplying it with something called as capitalization rate. Let's look at this. What do you mean by capitalization rate? Capitalization rate can be given like this. Capitalization rate in simple terms mean it is weighted average rate of interest on non-specific borrowings weighted average rate of interest on non-specific borrowings. So capitalization rate is weighted average rate of interest on non-specific borrowing. Then how do I calculate this? I'll calculate this like this. The total borrowing cost on non-specific borrowings. Total borrowing cost on non-specific borrowings divided by total non-specific borrowings into 100. Weighted average rate of interest on non-specific borrowings, that is total borrowing cost on non-specific borrowings divided by total non-specific borrowing multiplied by 100 will give me the weighted average rate or the capitalization rate, which should be multiplied with the borrowing utilized on the qualifying asset to identify the borrowing cost which is eligible to be capitalized for the purpose of AS16. Clear? Now that we are done with this concept of identifying what is a borrowing cost eligible to be capitalized, I'll have to discuss about three very important concepts. One, when should I commence capitalization? Number two, when should I stop capitalization? Number three, when should I suspend capitalization? Commencement of capitalization. When should I start capitalizing? When should I stop capitalizing? When should I suspend capitalizing? When I talk about commencement of capitalization, I'll put it like this. I will commence capitalization or capitalization of borrowing cost shall commence capitalization of borrowing cost shall commence when all the following conditions are satisfied. When all the following conditions are satisfied. Now, very important word here is all the conditions are satisfied. When I say all conditions, then that means each and every condition that I'm writing right now should be satisfied. The first condition that I'm going to list down here, that first one, borrowing cost should be incurred. Borrowing cost should be incurred. Number two, part B, expenditure on qualifying asset should be incurred. Expenditure on qualifying asset should be incurred. And finally, last one, part 3, that is the third condition, activities necessary for construction of qualifying asset are in progress. Construction of qualifying asset are in progress. Borrowing cost should be incurred. Expenditure on qualifying asset should be incurred, and activities necessary for the construction of qualifying asset are in progress. If these three conditions are satisfied, then you can say that the capitalization of borrowing cost shall commence. So all the three conditions are necessary to be satisfied for commencement of capitalization. What are the three conditions? First one, borrowing cost should be incurred. Expenditure should be incurred on the qualifying asset. Activities necessary for construction of qualifying asset are in progress. Now, that is the first topic which I discussed about commencement of capitalization. Similarly, stop. Cessation of capitalization. Cessation of capitalization. What do you mean by cessation? Means cease. Cease is nothing but stop. Capitalization of borrowing cost on a qualifying asset, on a qualifying asset should cease. When does it cease? Should cease if the asset is substantially ready. Substantially ready for intended use or sale. Capitalization of borrowing cost on a qualifying asset should cease if the asset is substantially ready for intended use or sale. Guys, the word substantially ready is very, very, very important, guys. So that means it is almost ready, need not be completely ready. So if it is almost complete in all aspects, then you can stop capitalization of borrowing cost. Very important. Last one is suspension. Not able to expand more, guys. There is a lot of discussion on why is it substantially ready. Why did that word substantially have so much of weightage over there? Cannot give it right now. Suspension of capitalization. What do you mean by suspend? Temporary stop. Yes, this is cease, guys, not cease. One commented, thank you for that. Should cease. Yeah. Suspension of capitalization. What do you mean by suspension? Temporarily, I'll halt. Temporarily, for that period, I'm not gonna continue with capitalization. Capitalization of borrowing cost should be suspended. When does it get suspended? When active development of qualifying asset active development of qualifying asset is interrupted for an extended period of time. What do you mean by this? I will suspend temporarily, I will stop capitalization when the active development, that means the construction of the qualifying asset, is interrupted for extended period. Generally, it occurs due to abnormal reasons. Abnormal reasons means something like this. What happened? There was a lockdown. Operations or commercial operations in that within that particular premises could not start or had been interrupted for an extended period of at least a couple of months. So their active development has been interrupted for an extended period. Therefore, it leads to suspension. There was a natural calamity which occurred in that premises, which has suspended the work of the development in the qualifying asset for a particular period. My employees have gone on strike for a couple of months. All these are abnormal reasons which generally lead to suspension of capitalization. One last point before I close the standard, which deals with capitalization should not be suspended if such an interruption is necessary for the development of the asset, for the development or construction of qualifying asset. If it is necessary for the construction of qualifying asset, then it is important for you to, if that interruption is necessary for the construction of qualifying asset, then it is not required to suspend the capitalization on the qualifying asset. Very, very important point, guys. Sometimes it does happen, especially in construction segment. You can't keep constructing every day. Sometimes what happens, there is a slab which is put up and it has to set for a couple of periods. And at least a week's time has to be given before I do any further construction. So that is necessary. Without that particular time gap, the construction is never complete or the qualifying asset is never done. Therefore, such kind of suspensions, if they are necessary for the construction of qualifying asset, then the capitalization need not be suspended. That will bring us to the end of the standard AS16. Let's take again a 2 minutes break before we start AS19, which deals with this. So, yes, guys. So let's continue. We were dealing with AS 16 so far. Let's get into AS 19 now. Which deals with leases, accounting for leases. What is a lease? A case of a lease is a very simple situation where one party gives a right to use the asset to the other party. So I have an entity A, I have an entity B. Entity A is the owner of the asset. So entity A, who is the owner of the asset, is giving entity B a right to use the asset. Is giving entity B a right to use the asset. Entity B in return pays periodic lease rentals. Entity A gives a right to use the asset to B, and entity B pays some periodic lease rentals to A in return as a consideration. Here, this is also called as consideration. Here, this is a lease. So whenever I talk about a lease, the first thing that one should know that a lease classification is the most important aspect of AS 19, where a lease can be classified either as a finance lease or an operating lease. Most critical part is all those who are requesting for problems, which I can see out there. I hope you're still tuned up. Guys, the problems, I'll give you the material with the solved answers. I think that would help, because within the given time span, it is very difficult to complete the standards itself. So fitting in certain problems here, I know a problem will always give you a better clarity on a concept. It's very difficult for me to fit in with the given time limit. So that's the reason why I'm trying to give you as much clarity on the concept as possible. So problems you can take from SICASA, I'll request them to make sure that those solved illustrations are given to you. I will make sure that they're available. So you will get the material of these standards along with those solved illustrations. I think that should help you people understand the standard better. Okay. So classification of lease. A lease can be classified only at the inception of lease. And at the inception of lease, they can be classified into two types. First type of lease is called as a finance lease. Second type of lease is called as operating lease. Okay. What is an operating lease? An operating lease is simply other than finance lease. That means I need to define what is a finance lease then. What do you mean by a finance lease? A lease which transfers substantial rights. Substantial rights which are incidental to the ownership of the asset incidental to ownership of the asset to the lessee. Here, in the lease transaction where I've taken, I will call A as a lessor and B as a lessee. A lessee is a person who acquires a right to use the asset from the lessor. So such lessee, if he is getting a substantial right incidental to the ownership of the asset along with the lease, then I will call it as finance lease. And someone will say, hands down, I did not understand one bit when you said substantial rights are transferred to the lessee. How do I know whether the substantial rights are transferred or not? Very good question. That is the reason why the standard also gave you further clarity on when can I call it as a finance lease. Before I go into that concept, I will still stick to the concept of classifying the lease. I will explain what is a finance lease and when does it occur, but I'm still sticking to the concept of classification of lease, and I gave you the concept. I told you one sentence and I said, a lease is classified at the inception of lease. And question comes up immediately. What is inception of lease? When do you call it as an inception? Inception means beginning of lease, not a movie, okay? It is the beginning of the lease. When do you call it as the beginning of a lease? Inception of lease is earlier or first one. Date of lease arrangement. The date of lease arrangement or part B, date on which significant or principal provisions of lease are agreed upon. Date on which significant or principal provisions of lease are agreed upon. What do you mean by principal provisions? Main provisions. For example, you go to an auditman, I'll give you a lease document. What are the primary things that you will notice in the lease agreement? In a lease arrangement, what are the primary provisions or the first things that you will check in a lease arrangement? What is the asset given under lease? Number 2. What are the conditions to use the asset under the lease? Number 3. What is the lease payment under the lease? Number 4. What is the periodicity of lease payment? Paid monthly or quarterly or half yearly or yearly? Number 5. What is the period of the lease? Given for 5 years, and does it have an extension option? Can the lessee acquire the leased asset at the end of the lease term? Can the lessor cancel the lease unilaterally during the period of the lease? Now, all these are the main provisions which I will concentrate upon whenever I get a lease arrangement. Those kind of provisions are called as principal provisions or the main provisions of a lease. So the date of lease agreement or the date on which principal provisions are agreed upon, whichever is earlier, will be considered as an inception of lease or the beginning of lease. Clear? So I'm saying a lease should always be classified at the inception of lease into either a finance lease or an operating lease. How do you classify? Based on how the terms of the lease are constructed upon. If the lease transfers substantial rights incidental to the ownership of the asset to the lessee, then I will consider it as a finance lease. Otherwise, I'll consider it as an operating lease. Someone will come up with a question. What if the lease has been amended during the period of the lease in such a way that it requires reclassification? I'll explain. Saying there is no reclassification of lease. There is no chance of reclassification of a lease. If a lease is originally designated or identified as operating lease, it will stay as operating lease throughout the lease term, can never be reclassified as finance lease, and vice versa. If it is originally designated as finance lease, it will stay as finance lease throughout the lease term, can never be reclassified as operating lease at a later point of time. However, I'll give a statement like this. If terms of lease are amended or altered, you can use either of the words, during the lease term, during the lease term, in such a way that if the terms of the lease are amended or altered during the lease term in such a way that it requires reclassification, the original lease agreement or original lease stands terminated, and the amended lease agreement shall be considered as a new lease. Shall be considered as a new lease. And classified accordingly. So what are we saying? We are here to say that if there is a change in the lease agreement, the change in such a way that it requires reclassification, then in such a case, the original lease stands terminated and the amended lease, that is the altered lease agreement, is considered as a new lease agreement and should be classified accordingly. This is regarding reclassification of lease. Classification should always happen at on the date of inception, either into a finance lease or an operating lease. Once it is classified, it cannot be reclassified during the lease term. If it requires reclassification because of amendments or alterations in the lease, then such altered lease agreement or amended lease agreement is considered as a new lease agreement. The old lease already stood terminated. Here, like I told you, I will talk about indicators of finance lease. What are the indicators of a finance lease? Guys, indicators of finance lease means, like I told you, I will consider a lease as a finance lease if the lease transfers substantial rights and obligations of substantial rights and obligations of the leased asset are transferred to the lessee. How do I know substantial rights and responsibilities are transferred to the lessee? What did I given you here? Substantial rights incidental to the ownership of the asset is transferred to the lessee. When do you say substantial rights are transferred to the lessee? So therefore, a certain indicators are necessary to say that these lease indicates a finance lease. All right, there are total 5 indicators. First one, attain. These transfers is asset to the lessee at the end of lease term. The lease transfers a leased asset to the lessee at the end of the lease term. So that means as the lease term progresses by, as the lessee keeps on paying lease rental over the lease term, at the end of the lease term, after making the last lease payment, the lessee has obtained that particular leased asset in ownership. Just example is hire purchase agreements. On payment of the last installment, the hire purchase asset will be transferred to the hire purchaser. Same way, a lease transfers a leased asset to the lessee at the end of the lease term. Part B, second indicator is when a lessee has an option. Lessee has an option to acquire the leased asset at the end of lease term. Acquire the leased asset at the end of lease term. The lessee has an option to acquire the leased asset at the end of lease term at a price which is sufficiently lower, than its fair value when the option becomes exercisable. When option becomes exercisable. Read the sentence so far. Lessee is given an option to acquire the leased asset at the end of lease term. That means lessee, if he wants to buy the asset at the end of lease term, he can buy at what price? At a price which is sufficiently lower than its fair value when the option becomes exercisable. That means what? I have given you an asset for 5 years of lease. At the end of the 5th year, the lessee can acquire the asset at 20 rupees only, while the fair value of the asset at the end of the 5th year was actually 100. Since you have been using the asset continuously for a period of 5 years, I am giving you an option to take off the asset at a cheaper price. This is also an indicator of finance lease. Though the lease by itself is not transferring the asset, but the lease is having an option. The lease contains an option to the lessee to buy the asset at the end of lease term. Whenever this word option is given for the lessee, there is an extended part. Okay. He says it is reasonably certain it is reasonably certain that the lessee will exercise the option that the lessee will exercise the option when it becomes exercisable, when it becomes exercisable. When does it become exercisable? At the end of lease term, when the option becomes exercisable, it is reasonably certain that the lessee will exercise the option. This is a compulsory condition whenever the word option of the lessee is given. Whenever the lessee has an option, always this condition comes up where he says it is reasonably certain that the lessee will exercise the option when it becomes exercisable. So second point has three parts. First one, lessee has an option to buy the asset at the end of the lease term. Second part, he will buy it at a price which is sufficiently lower than its fair value when it becomes exercisable. Number three, it is reasonably certain that the lessee will exercise the option. If these three put together are satisfied, then it is also an indicator of finance lease. Third condition or third indicator. Lease term covers majority of economic life of the asset. Guys, one small thing that you do, I'm not going to explain this logic, but try to identify what is the difference between economic life and useful life. They're not both the same. Please make sure that you identify the difference. This term covers majority. Majority means what? Greater than 50%. More than 50% of the economic life of the asset is also an indicator of finance lease. Part D. Present value of minimum lease payments. We will talk about this concept of minimum lease payment, guys. This is called as MLP. The present value of minimum lease payment is substantially equal to fair value of the leased asset. Substantially equal to fair value of leased asset. The present value of minimum lease payment is substantially equal to the fair value of the leased asset. This is part D of, so part D or fourth indicator of finance lease. What is the fifth indicator of finance lease then? The fifth indicator or the last indicator of finance lease says that asset is customized to lessee's requirement and no other party can use the asset. No other party can use the asset without major modifications. Without major modifications. The asset is customized. It is so customized to the requirement of the lessee that if the lessee does not want to use the asset, no other party can use the asset without majorly modifying the asset. That is also an indicator of finance. Remember, guys, we have discussed about 5 indicators of finance lease, but let me tell you, this list is not an exhaustive list. When I say it is not exhaustive list, that means these are not the only indicators of finance lease. These are a few indicators which are given in the standard. There could be many more indicators of finance lease depending on each lease agreement. Lease transfers the leased asset to the lessee at the end of the lease term. Part 1, first indicator. Second indicator, lessee can purchase the leased asset. Lessee has an option to purchase the leased asset at the end of lease term. The price at which he can purchase the leased asset is significantly lower than the fair value of the asset. And it is reasonably certain that the lessee will exercise his option to purchase the asset. Third one, lease term covers a majority of economic life of the asset. Number 4, present value of minimum lease payment is substantially equal to the fair value of the leased asset. Number 5, the leased asset is customized to the party's requirement or lessee's requirement such a way that no other party can ever use the asset without majorly modifying the asset. These are the most important 5 indicators for a lease to be classified as finance lease. Now, so much that we have discussed, there are things that I have to start understanding. The things which I have to start understanding is, what is this concept of minimum lease payment? Right? What do you mean by this word lease term? We've also had this word lease term here. So my question is, what is lease term? What is minimum lease payment? To get to know these two words, I will make sure that first I'll get into the concept of recognition and measurement. When I talk about this concept of recognition and measurement, I'll have to broadly discuss about 4 things, guys. Recognition and measurement of finance lease in books of lessor. Recognition and measurement of finance lease in books of lessee. Recognition of operating lease in books of lessor. Recognition and measurement of operating lease in books of lessee. 4 things that I have to discuss. So let's start with. First, under this, finance lease. Like I told you, under finance lease, I'll have to further talk about books of lessee and books of lessor. Okay, let's see. First, inception of lease. First, at the inception of lease, think from lessee. Substantial risk and rewards of the asset. Substantial risk and rewards incidental to the ownership of the asset are transferred to the lessee under finance lease. Therefore, substance over form, lessee has now become the owner for accounting purposes. Title of the asset is not transferred. Title of the asset or the ownership of the asset, according to your title, is still with the lessor. But lessee, since he has acquired the rights to use the asset and all the responsibilities along with it, so all the substantial risk and rewards incidental to ownership of the leased asset are transferred to the lessee. Therefore, the leased asset should be now recognized in the books of the lessee. So he'll recognize the entry like this. Leased asset account debit. Don't forget, lessee, while taking the right to use the asset, also has an obligation to pay. What is the obligation to pay? The obligation to pay lease payments to the lessor. So, to lease liability. What is the liability? The liability to pay periodic lease payments to lessor. This entry are in the books of lessee. Measurement should be measured at door of fair value of the asset part B, present value of minimum lease payment for the lessee. So I'm saying the lessee will recognize the leased asset. So he'll write the entry as leased asset account debit to lease liability. His liability to pay the lease rentals periodically is recognized as a liability. This transaction or this entry will be measured at lower of the fair value of the asset or the present value of the minimum lease payments. SR exact ulta entry he'll write. Lease receivable account debit. If it is a liability to lessee to pay lease rental, asset to lessor to receive periodic lease rentals from the lessee. If lessee has recognized the leased asset, I will de-recognize the asset. Here, the transaction should be measured at net investment in lease. Also known as NIL. So the question comes up, first of all, what is this aspect? Present value of minimum lease payments. How do I calculate net investment in lease? These two are very important aspects to be dealt with. So let's see, how do I know or how do I calculate this net investment in lease or your present value of minimum lease payment? But remember, guys, I will talk about that after I look at subsequent recognition. This is the initial recognition in the books of lessee and lessor at the time of inception of lease. Subsequent recognition on balance sheet date or on lease payments on lease payment. If you observe, the lease payments are periodic lease rentals. If you look at hire purchase, what happens? You pay installments to the hire vendor. Each installment is broken down into two parts: repayment of principal and interest. Same way, every lease rental will be broken down into two parts. Lease rental should be broken down as payment of principal plus the amount of interest, which is also called as finance charges under finance lease. So what I'll write? So let's see the entry. To bank, because lessee pays. Lessor received bank account debit. What is he paying? These rentals. These rentals are broken down into principal and interest. What is the principal portion? It is nothing but a reduction of your lease liability, which I earlier credited. Every time I make the lease payment, such lease liability should be debited. Lease liability account debit. Interest or finance charges. It is an expense to the lessor, debited. Finance charges account debit. Lease liability account debit to bank. Exact reverse entry will be written by lessor. Whatever I receive as lease rental should reduce the amount of my lease receivable. Therefore, lease receivable should be reduced to lease received. It will in turn give me a reduction in the value of the asset. Lessee had finance charges as expense. To the lessor, thus finance income. Expense to lessee, income to lessor. Okay. On balance sheet date, the lessee recognized the leased asset. Therefore, the lessee should recognize depreciation also. Depreciation will also be recognized only by lessee. Well, there is no depreciation entry to be written in the books of lessor because the lessor has de-recognized the asset initially. Look at, go back up above. Lease receivable to asset. He de-recognized the asset. Therefore, depreciation entry will not be recorded in the books of lessor. Depreciation entry will only be recorded in the books of lessee. So, this is the entry to be written on each balance sheet date and on each lease payment, and these are the set of entries to be recorded by both lessee as well as lessor. Now let's look at it. Let's get into the concept and let's start measuring it. Here I find something called as net investment in lease. Let's see what is net investment in lease. Net investment in lease or NIL is equal to gross investment in lease which is nothing but GIL minus unearned financial income. To FL. Okay. I leave some line space because I have something else to be talking about in NIL. And let's try to understand what is GIL first. Gross investment in lease or GIL. My GIL is nothing but these rentals. And guys, I'm sorry. Minimum lease payments or MLP for lessor plus GRV. Let's see what is this MLP and GRV then. First, minimum lease payments. Minimum lease payments or MLP. MLP, first from the standpoint of lessee and also from the standpoint of lessor. I need to calculate what is the MLP for lessee and what is the MLP for lessor. Minimum lease payment means what? That is the bare minimum payment which happens from the lessee to the lessor during the lease term. Or that is the minimum amount that the lessee pays to the lessor over the lease term. Let's see, my calculation will go like this. Lease rental paid over the lease term. How much lease rentals you are paying throughout the lease term plus GRV, guaranteed residual value, by the lessee. What about lessor then? Lessor also, it will be very similar, because he is also going to write the same thing, because whatever lessee pays, lessor receives. These rentals paid by the lessee over the lease term is received by the lessor plus GRV, guaranteed residual value, either by the lessee or by third party. This is the only change when I talk about minimum lease payment for both lessee as well as lessor. So when I say GRV paid by lessee or third party, what do I mean? What is guaranteed residual value first? GRV. What? Guaranteed residual value. Guaranteed residual value is nothing but the amount which the party will pay at the end of the lease term to take over the leased asset. It is nothing but the amount paid by the lessee or by the third party to acquire the leased asset at the end of lease term. I hope you understand what I'm saying. After 5 years, you will take over the asset at a particular value. After 5 years, I don't know what is the status of the asset, whether it will be in a proper condition or not, whether the asset will exist or not. I'm giving you a guarantee right at the beginning itself. Such guarantee the lessee can give because I am only using the asset, obviously it's easier for me to give a guarantee. Someone else who is not even related to the lease transaction, third party is acquiring the leased asset. That can happen. Let's say a bus is there, a bus is taken by a tour operator on lease for 3 years. After 3 years, the tour operator will say, I don't want the bus because it's already old. My passengers will start complaining. So what the lessor will do? Lessor will already make a contract with a school or a college to take over this asset after 3 years. School or college is very enthusiastic because they don't mind even using a poor grade, buses, because that doesn't matter to the student. What matters to the student is the education given by the school or a college, not the bus in which they are coming to the school or a college. But remember one logic where I tell you, whenever such guarantee is given, it is always less than RV, which is nothing but residual value. What do you mean by residual value? Residual value is nothing but fair value of leased asset at the end of lease term. GRV is always less than RV. Fair value of the leased asset is 100 at the end of lease term. After 5 years, that is the end of the lease term, will you take over at 100? When the fair value is 100, why should I give you a guarantee for 100 rupees? So therefore, my guarantee when I give you at less than residual value. Your mobile phone has a guarantee of 1 year. Does it mean that it will only run for 1 year? No. More beyond that, but the manufacturer is giving you a guarantee of 1 year. So guarantee is always given for a lower value or a lower term than the actual term. Lower residual value than the actual residual value. I can write like this. GRV plus some amount which is UGRV is equal to RV. Or I can write like this. UGRV is equal to the difference between the fair value and the guaranteed residual value. UGRV stands for unguaranteed residual value. Now you understood where I got the UGRV from. Go to GIL, you will get the UGRV. Oh, I'm sorry, guys. I wrote GRV. UGR. So, minimum lease payment from the standpoint of lessor, that is the lease rentals over the lease term, plus guaranteed residual value, either guaranteed by the lessee or the third party. Both cannot give you a guarantee. Only one fellow can give a guarantee. Either the lessee is giving a guarantee. If he does not give a guarantee, I can take a guarantee from third party. Plus UGRV. Plus UGRV means the difference between the residual value and the guaranteed residual value will be called as a UGRV. Here. There's something called as unearned financial income also. Till now, what I discussed is gross investment of lease. But what is this unearned financial income? Unearned financial income, UFI, is equal to GIL minus present value of GIL. Gross investment in lease minus present value of gross investment in lease. What is gross investment in lease? Minimum lease payment from the standpoint of lessor plus unguaranteed residual value. Up above. What is net investment in lease? I don't want gross investment in lease. I started the discussion on gross investment in lease because I need to calculate something called as net investment in lease. How do I get net investment in lease? GIL minus unearned financial income. Let's try to expand this. GIL minus, what is unearned financial income? GIL minus present value of GIL. Correct? Check this now. GIL minus GIL plus present value of GIL. Therefore, NIL is equal to present value of GIL. A present value of gross investment in lease is equal to my net investment in lease. What is gross investment in lease? Present value, the minimum lease payment from standpoint of lessor plus the unguaranteed residual value, which is nothing but the difference between the fair value of the leased asset at the end of lease term minus the guaranteed residual value either by the lessee or by the third party. Here, this is the concept of measurement. So we have seen minimum lease payment for lessee as well. If you check, that is exactly the measurement in lessee. Present value of MLP from the standpoint of lessee. Clear? So that will basically bring us to the end of discussion regarding measurement of a finance lease in the books of lessee as well as the books of lessor. One last definition which I will include is regarding lease term. Lease term is nothing but a non-cancelable period for which lessee acquires the right to use the asset plus, in addition, period for which the lease can be extended at the option of lessee. Non-cancelable period for which the lessee acquires a right to use the asset plus the period for which the lessee can extend the lease. Option of lessee. Whenever there is an option of lessee word, like we have seen under indicators of lease under the second indicator, there also the lessee had an option to purchase the leased asset. Here the lessee has an option to extend the lease. There's always an additional condition which has to come in. It is reasonably certain that the lessee will exercise the option it is reasonably certain that the lessee will exercise the option. So we have got this. So what are we looking at? It is a non-cancelable period for which the lessee acquires a right to use the asset, plus the period for which the lessee the lease can be extended at the option of the lessee, and it is reasonably certain that the option will be exercised by the lessee at the end of lease term. That is lease term. So if you observe, we have covered the entire concept regarding finance lease, but one thing which is left out right now is recognition and measurement of operating lease. I'll just finish it off in one sentence, guys. Operating lease, lessor, lessee. Remember, guys, lessor, these rentals will be recognized as income. Will be recognized as income. While lessee, these rentals will be recognized as expense. Remember, guys, either it is an income or expense to the lessee or the lessor. It should be measured on either it could be an income or it could be an expense. Income to the lessor or an expense to the lessee, measured on straight line basis over lease term. Straight line basis over the lease term. Guys, what is this straight line basis? Because this straight line basis will give rise to a new concept called as deferred rent. I don't have much time here to discuss about this concept, but one of the very, very important concept, guys. So please make sure that you take care of this deferred rent concept. It is measured on a straight line basis, and the word straight line basis will give rise to a new concept called as deferred rent. So please make sure that you go to the concept and check what is a deferred rent, how does it emerge, and why does it arise. Right, guys? Now, last concept of the standard AS19, which I brushed through in probably in the last 1 hour, the last concept is regarding sale and leaseback. So guys, I have only 15 minutes of time left. I don't have much to really discuss about because there's a lot of discussion which has to go on in sale and leaseback as well. I just brushed through the concept of AS19. AS20 and 26 are still remaining. If I go to the top where I started, I have written a lot. Yeah. Sorry guys, there's also AS12. Someone mentioned in the chat. Absolutely, but that's a very, very, very simple standard. We have covered only these three now. But these three put together are nothing short of 25 marks at least. Most of the times you find 8 marks coming out from here and at least 6 to 10 marks coming out from here. At least I'm talking about. Balance normally 5 marks can come from here. The other most important standard of AS20, which also covers another 8 marks. But we haven't covered this concept, but I want you people to basically do one thing. With the given time, I cannot do anything further, but I can give you one small logic. I think you people are looking at my YouTube channel, which is there, which is free of cost. Okay. Please make sure that AS20 and 26, these two standards, you check from that particular YouTube page. These two standards you check from there. The rest of the standards is optional for you. I'm not really bothered about whether you are going through with those standards thoroughly or not. But make sure that concept of what is this concept of deferred rent which emerged under AS19. Last I explained. There's a concept of AS19 deferred rent which came up. Yeah. This concept of deferred rent, sale and leaseback under AS19, AS20 EPS. Most important is the concept of diluted EPS and the basic EPS there. or how are they calculated and what is the denominator to be calculated under EPS computation. And then 26, intangible asset, plain simple standard. All you have to do is doing something, probably you are having your bath or you're walking on the street, make sure that you keep listening to it. I'll make sure that 26 becomes the most easiest standard because there's nothing complicated. AS 19 is not so simple. It is definitely not simple. It is tend of complicating towards the standard. AS 20 is not simple. It is definitely complicated. But 26 is not like that. Unlike these two standards, 26 comes across as a much simple standard. So all I can tell you is please make sure that these two standards you pick up from there. Since I don't have much of a time, I'm not able to do it right now. Okay. So I think we will have to wind up in 15 minutes. I can be taking your doubts if possible. And all those people who are looking at or who want to have my YouTube channel up there, I'll just put it up wrong. Check from this. Yes, guys. So that is my channel, Reporting Rack. You can check from there. You'll get those. Any doubts, I'm ready to pick up. GIL is equal to MLP of lessor plus GRV. Absolutely. I agree on that point. I agree on that point. I think I've changed it, I guess. By mistake, I've written, yeah, I've changed it. It is UGRV, correct? GIL is already included in MLP and you have included previously. Yeah, GRV, yeah, that's what. I've already corrected it, no problem. Someone else has a, sir, UGRV has to be added to GIL. Yes, UGRV has to be added to GIL. See, I'm looking at investment in the lease. So my investment in the lease is the amount which I'm going to get throughout the lease term plus the amount which I can fair valuely get at the end of the lease term. So both have to be taken into consideration. That's the reason why I'll have to include both of them, GRV as well as UGRV. If I have to expand this further, then this goes like this. Lease rentals over lease term plus GRV plus UGRV. Again, GRV and UGRV are nothing but RV. So I can write it as lease rentals over lease term plus residual value. Or I can put it like this. The amount of lease rentals you will get throughout the lease term plus the fair value of the asset at the end of the lease term is equal to your gross investment in lease. Yeah, Neil, I'm sorry. Rectified later on. Yes, guys. Guys, there is a Telegram channel. You can post your doubts if possible, or there are YouTube videos. You can post it as a comment. I'll reply there. Anything is fine. Please make sure that you people are communicating. Last attempt, give your best shot at it. Give your best shot at it. I've covered 3 standards, guys, in 3 hours. In 3 hours, I could cover 3 standards. Another 3 hours, you can complete all the rest of the standards. So please make sure that you spend so much of time because it carries 40 marks of weightage. Not less, man, not less. It's 40 marks of weightage. So please make sure that you pay enough attention to these standards because these are the ones which will get you to that par score of at least 70. Say 68, 70, 75 is the odd score which I look at advanced accounting because that will give you the aggregate out there. Yes. So make sure that people take care of it. I'll stop the stream here. Thanks a lot. Make sure that you people stay away from COVID. Make sure that you're staying home, staying safe. While writing the exam, please take care of enough care. Don't fall sick. Please make sure that you be your good health. That is when you can write your best exam there. Thanks a lot.